I mean, this kind of goes without saying. We have to start with this. It's been an incredible year. And it didn't really matter what you owned this year. Everything did really, really incredibly well. Usually when you have a year where the stock markets are up like this, the bond market doesn't do so well, right? Because people are taking money out of bonds and sticking it into stocks. And we'll talk about that a little bit more in a second. But look at this. The bond market produced about 8 or 9% this year because rates were going up and then, oh, surprise, they went back down, right? So the bond prices rose. Okay, so fantastic year across the board. We weren't the best market. Internationally, there's lots of great markets that did really well. A mix of emerging and developed markets. Also, markets that did not do very well. Okay. Did anyone walk into this thinking that the U.S. market was the best market? So it's interesting that the conversation I've had probably for a year and a half now is, Jonathan, and I had it a lot in the last week or so. Jonathan, why do we own international stocks? They seem to be awful. Why do we own those? And obviously that's not awful, but there are less than, right? So on a relative basis, people are wondering, how can I get more? But when it comes to this money decisions, people aren't always rational, right? Has anyone had that sense? That the markets are up, so they have to go down. If they're up this high, they got to go down, right? No one is gonna say, yes, we had that sense. Yes. Yeah. Who's calling my office then? That's must be not this crowd. Okay. So we're gonna talk a little bit about psychology, but the fact that people are fallible is your biggest advantage. The fact that we're fallible is our biggest disadvantage. Does that make sense? So when we have conversations about international versus domestic, or why do we have fixed income, or why isn't there more gold, or shouldn't we have more oil, or shouldn't we have more .com, or shouldn't we own more REITs, we have to remember that the prudent investor admits that they don't know what's coming down the pipe. We don't know what happens next, okay? And part of it is these mental biases. Has anyone done any sort of psychology studies of the cognitive and emotional biases that we carry with us? A little bit, here and there. So can anyone tell me what confirmation bias is?
You give the things that confirm what you
already believe.
Right.
Disregard what contradicts.
Right. See, we have this imagination, we have this belief that we want to make a decision, so we go gather all the relevant data, and then we look through the data dispassionately and we make a choice. That's not how our brains work, though. We have preconceived ideas, and our brain filters the information coming to us and highlights this you might want to pay attention to, this you don't need to pay attention to. And the highlights are things that you already agree with. And the things you're not supposed to pay attention to, according to your brain, are things that disagree with your already preconceived notions. So confirmation bias is something you have to almost force yourself to read people that disagree with you on a regular basis. Right, so we were talking over here earlier, Jack and I, about, he was like, how do you present all this stuff? And I read 60 blogs on a daily basis. I read economists across the country. I read both sides of the aisle. I'm reading constantly all the time. And so it helps me challenge my own notions of what I might think I know. So anyone know what information bias is?
Choose a source more to your liking.
Sort of. Information bias is what's readily available to you. So you find, okay, so you try to explain something, and this kind of goes with oversimplification, but the information you have is the information you use. And you don't have all the other information, so you have a bias towards what's readily available to you, okay? So do you have at any one time all the information about the global economy and the markets?
No.
Does anyone? No. So when you go into the whole conversation about markets and economy, what you should bring with you as a baseline is humility, okay? Not a belief on what's going to happen next. Everyone knows loss aversion, right? I've talked about this a lot up here. So Kahneman and Tversky, Kahneman won the Nobel Prize for basically studying the effect that we all prefer. We dislike losses more than we like gains. So we are more averse to loss than we are appreciative of gains. Make sense? Does anyone disagree with that? No. Okay. Oversimplification. See how that ties with information bias. Information is what's available, but then when you watch CNBC or you watch media, they're going to say, oh, the market went up today because of the unemployment report. Does anyone get sucked into that? I'll admit it. Sometimes I go, oh, that makes good sense. We had a good unemployment report, so that must be why the market went up. No, right? The market moves are inexplicable, and the daily movement of markets is pointless and meaningless anyways. So hindsight bias, this one's fantastic. This one I run into all the time. Anyone might take a stab at what hindsight bias is?
If I had bought Apple the first year.
I woulda, coulda, yeah. I should have done this, I should have done that. But we have to just give ourselves a break. Like, we don't know what the future holds when the future's in front of us. It's really easy to say, well, this is what happened after the fact. But we have to make a decision now with limited information. So hindsight bias causes folks to take and think in a straight line. That which just happened will just continue as it is. So the S&P 500 has done really, really well, outperformed other things. It's probably going to continue the way it is, right?
No, that means it's going to drop.
Neither. Okay. So we want to talk about, had a great run. So this is Christmas Eve 2018, right? We just had a 19.8, 20% decline from October to Christmas Eve. And at this point, everyone was panicked. And do you remember what drove this?
China.
What about China? Tariffs. It was a series of presidential tweets that drove the panic and all the stuff around that. And that's interesting. So then what happened when this happened right here? See that's May. May was a 7% decline that stimulated a flight from equities that we can measure. We can measure who leaves ETFs, who leaves mutual funds. We can see how many people are running from markets. And that 7% decline caused more people to run from markets than ran in 2008. So what does that tell you about the psychology in the world? It's existential panic. Like we are terrified of markets. Like the slightest blip, people just experienced this, then they just barely recovered, and then it dipped again, and people were like, give up, and they sold. And they sold en masse. Okay? So when we're talking about psychology, we just want to recognize this tendency in ourselves. Okay? Because the best thing we know is you build an appropriate portfolio, and you hold on to that portfolio, and you rebalance that portfolio. And that's pretty much the sum total of what you can do to add value long term. Okay? Because anything you do, I'm scared, I'm going to get out. Or, wow, look at Apple, I'm going to buy more, right? This is what ends up happening. If you miss the 5 best days, where's this? Here he goes. So if you invest $10,000 at the beginning of 1988 and you keep it invested till the end of last year, that $10,000 is worth $265,000. Just the S&P 500. If you miss the 5 best days, if you decide, you know what, right now I'm scared for some reason, I'm going to get out, and one of those days happens to be the 5% up day. 5 times, you cut it by an enormous amount. If you miss 50 days, your 265 is now only 25. So does anyone think they can pick the days they should be in and the days they should be out? Not in this room, but does anyone out there think they can pick? And I know some people in here were like, oh, I can do it. They're just not going to admit it right now. Right? Okay. So this is why when we talk with clients, someone brand new coming to the office, this is why we start with, and Scott always loves it, the 3-legged stool. Does anyone here remember the 3 legs of the 3-legged stool? Okay. First leg, planning. Second leg, implementation. You buy some insurance, you invest. Third leg, education, communication. So this is why we start everything with planning, because planning gives you the light at the end of the tunnel. Planning gives you, this is the expectation, this is what we need long term. We don't need to much care what happens in this 3 months or 6 months. You still care, I understand that, and we still have to do it the right way, and we still have to perform with benchmarks and those kinds of things. I get that. But to get excited or depressed about something happens, you need something to look at. So I talk about this, anyone here meditate? Okay, 3, 4, 5. Oh, wow, that's fantastic. You're my people. So when you meditate, if you meditate and your breath is your focal point, and you get distracted by the cat or a kid or a thought or a meeting, premonition, what you do is you bring your mind back to your breath. Okay? When you invest and markets go haywire and it freaks out and it's maybe really exciting or maybe it's really depressing, you bring your focal point back to the plan. The plan is the thing that helps us decide what we need to do. It is the core. It's the thing that manages our own behavior for us. So we got to have that. So we got to know what your goals are to get to a plan. And then you invest based on that, right? You maybe, and this is just a variety, maybe the goal is, maybe you're 35 and the goal is just to increase your assets. Or maybe you're retired and you want to conserve and spend what you have. Those will all of those will create a different kind of portfolio. The appropriate portfolio fits the plan for the money. So about 15 years ago, clients would come in, or prospective clients would come in and say, here, Jonathan, here's my whatever, $1 million. I'd like you to manage this. And the question we'd have to ask was, to what end? What are we managing for? Because that will determine how we're going to manage those assets. And it'll determine the expectations we're going to suggest you should have. Okay. Still, there are good reasons to change a portfolio. And I'm going to say that the first two are the ones we get to right at the beginning of a relationship, right? So many people come in and they're not allocated or diversified. So many people. And then some people come in and they're diversified. They have 4,000 holdings, none of which play with each other well, right? So you may want to say, oh, I've done it wrong up till now. I need to change and do something that's right. Another thing is some people rely on Kramer. They may be diversified, but maybe they have, buy or sell. Maybe they're relying on some sort of a not a predictable outcome. So you may want to say, okay, what's the academic evidence tell us? How should we invest? Okay. And then these other ones are things we do on a regular basis. Have someone's goals changed? Maybe someone lost a job and now they need a current income instead of having a long-term growth plan. Maybe someone got remarried. So circumstances change. This happened at the end of last year, or actually in January when I gave this presentation of 2018. I said, if you have a risk tolerance question, call us and talk to us. I remember that was right after the 20% decline. So we had a couple conversations. Jonathan, should I change? No, now's not the time to change. And a couple people later in the year, June, July, we've reduced the risk in their portfolios because they weren't comfortable with that 20% decline in fourth quarter. But that, January was not the time to make the change. You wait for it to recover and then you make the kind of change, okay? And then also major life event, marriage, death in the family, new child, adoption, whatever it might be. Then finally, the one that happens on a regular basis is this: rebalance. Go back to the appropriate portfolio, because anything you invest in, it's going to change in a week. It's going to be different. So when you think about the academic evidence, what we're looking at is the story that companies tell us. And I'm going to repost, just in the interest of time, there were 4 sections to the last video we did. And I rewatched the 4th section, and it's all about the portfolio process we have in place. And I'm gonna repost that to our website so you guys can see that, rather than go too deep into it. But I just want to say that the things we look at, the big things we look at, are price. Price is price gives us all the information. Then you can look at price, and then you look at book value, price to book, price to earnings. The current price we take as reality. Because you have to remember, there are thousands and thousands and thousands of people trading everything that's tradable. So if there's 100,000 people trading Microsoft every day, we're pretty sure that Microsoft is trading at the right price. We're not trying to guess how it might change in the future. We're not trying to guess Apple's next product cycle. We're not trying to guess whether Tesla can raise the next round of funds or not. Because we don't know that. No one can know that. But we can tell what the market thinks the price is, and then we can look at the business and see what kind of earnings they're producing. Okay? That's how we know what to invest in. And then the dividends are also a sign of value. Okay, so there's a mirror image between 2018 and 2019. 2018, we had fantastic earnings growth. Look at this. And we talked about this last January. We had 25%, I think at the end of the year it averaged out to 23% earnings growth. Why? Taxes. Okay. And we had a down year in markets, 2018. This year, just ended, 2019, we actually had a down year in earnings, but we had a tremendous up year in markets. Okay? Does anyone see why or see anything that's interesting about that? We ended the year down. I think in January we talked about how we're actually slightly below fair market value on the S&P and on global markets. And now, even though earnings are down, we had a lot of space to make up. So the prices could go up quite a bit and still be, now we're slightly above fair market value in the S&P. Right? So the reason I would say, if there's a reason, is it was a good buy. Right? It was cheap. So earnings matter. And then this is really interesting about 2019. So because of the tariff stuff, because of the refiguring of supply chains and all these kinds of things, if you had a company that had more than 50% of the revenue from the United States, that company was up a smidge, right? If you had a company that had a revenue from outside the United States, they got really hurt, right? So that's how we get this average. That's how we get these. It's 4% down. We're about 50% inside, 50% outside in the S&P. This is the Shiller. We're gonna spend just a quick moment on this. And we're gonna send it on this because it's unique in the equity world. What happens when one subset of equities does really, really well for a long period of time, you get this. This is the S&P 500, and we're at a 2x, almost 2 times the long-term average PE ratio, the Shiller PE ratio, which is a 10-year normalized PE ratio. So about 2 times average. So that's kind of high, right? That's kind of high. That is not true internationally. It's not true in the emerging markets. It's actually not true for the value portion of the S&P. It's also not true for the smaller companies in the S&P. It's true for about 6 or 8 companies. So Apple's growth in 2019 was 3% of the 28 or 29% of the S&P. That's 3% of the 28. So what's that? A tenth. Basically, a tenth of the growth of the S&P was Apple. And if you add, not Netflix, because Netflix got hammered, Google, if you add Amazon, if you add, just a few companies, you get basically the whole return of the S&P, right? So that's where this PE is getting out of control on the S&P, is because we have a few companies that are doing really, really, really well. So we have in our process, while this is true, we have a reduced exposure to those companies, right? We do that intentionally. We look for value. Okay. And this is why far more money has been lost by investors preparing. This is the only quote you see probably once every 2 years. Like, this is Peter Lynch. He's a legend. He says this, and this applies all the time. You're going to see this more and more and more and more, because so many people are trying to predict. The key is not to predict. Be humble about this. Okay. So bond markets did really well in terms of their return, about 8% last year. But this is all the stuff that happened throughout the year, from January through December. And this is probably why we got such good price in bond markets. Rate cut, rate cut, rate cut. No one saw that coming beforehand. So there were some signs of weakness coming from tariff talk, coming from tweet storms. Federal Reserve cuts rates. There was talk immediately thereafter, or immediately before there, of inverted yield curves. Remember that? Inverted yield curve, and that's a harbinger of recession. That's therefore people were talking about risk off, and people said, well, will the United States go to this? There is $17 trillion of debt overseas that's negative yielding. $17 trillion, meaning you give them $1,000 and they promise you that you're going to get $995 back. So, I've had this chart in here a number of times. Here, I said that incorrectly, admitting my own mistakes. That's the bottom of the bond, right there. It's going to go up from here. And I said it here. I'm going to say it again today. So we can't go much lower. So in terms of fixed income in the portfolio, fixed income is a ballast. It's something that protects a portfolio. Equities provide return. Fixed income provides a ballast. There's almost as much, not as much risk in fixed income as equities, but there's much risk in fixed income as there is upside now. So rates will go up. They may come back down. We may see this. We may see more of this up, down, up, down, up, down for some time here. But if rates go up from here, bond values are going to go down. Something to be aware of. They're not going to go down 50% like a stock value can, but bond values can go down from here very easily. So we're favoring very short-term bonds. We're very short-term bonds and credit over government. Okay. And here, reduced ballast and meager expected returns in certain core government bond markets. Starting point for strategic asset allocation. So everyone is questioning this. Everyone is questioning government bonds as a strategic part of an asset allocation, which is why if we have government bonds, they're very short, which means they pay us nothing, but they're protection. That's all they are.